For Morningstar, I'm Jeremy Glazer. Here today with Josh Peters, he's the editor of our Dividend Investor newsletter. We're going to look at recent trends in dividend growth and what it means for dividend investors. Josh, thanks for joining me.
Good to be here, Jeremy.
We've seen a slowdown in earnings recently. Has that also translated into a slowdown in dividend growth?
Yeah, we are starting to see dividend growth slow down. We've been at what has historically been a very, very high rate of dividend growth for the S&P 500. To use that as a benchmark for the market. I mean, you don't typically see year after year after year of double-digit increases, but that's what we've had, actually, since dividends bottomed out after all the dividend cuts back in 2008, 2009. So some of that was recovery in earnings. That's good. Some of it is an increase in the payout ratio, and I've believed for a long time that companies have devoted too little a share of their earnings to dividends, prioritizing buybacks especially, as well as acquisitions as a use of cash. I wanted to see the payout ratio of the market come up. The market historically would yield between 3 and 6% up until the mid-90s, and since then we've been lucky to yield 2. I think that older, higher yield environment with a higher payout ratio is better for investors. I think it's better for the companies too. Provides more discipline in capital allocation. But at some point, dividends aren't going to keep growing unless earnings are growing too. And with the slowdown in earnings growth, you're also seeing that slowdown in dividend growth as well.
So when you're looking at potential opportunities now, how does that factor into your calculus? Do you worry that growth is going to be so slow that you need to get paid more up front?
I think that's a really good way to think about it, which is some people assume that if dividend growth slows, then this dividend thing is over. It's time to go off and find growth elsewhere. And I would maybe start by asking where. You've seen what happened with the FANG stocks. Which is if you pay too much for growth just because it happens to be scarce and you ignore yield as a component to your total return, you can get burned. I think it's much more advantageous to structure your portfolio in a way so that you've got lots of stocks that yield 3, 4, 5%, get you halfway or thereabouts to a good long-term total return on income alone. That really takes the pressure off companies to generate earnings and dividend growth in order to meet your returns. The returns that you need to meet your financial objectives. But when growth slows down across the board, then you also have to realize that even from those higher yielding stocks, you may not get the growth you expect. Staples is a great example where these are companies that historically had higher than average payout ratios. And over the last couple of years, you've seen a lot of companies continue to raise their dividends, even though earnings haven't been growing much. I mean, you've had pressure on the consumer. Say in the packaged food area, General Mills has struggled to grow earnings because people aren't spending as much time in the middle of the grocery store. They're out on the edges where there's not so many other products. Foreign currency has really been a huge headwind for a name like Philip Morris International or Procter & Gamble. And you've seen dividend growth rates coming down in these high payout areas. I think the dividends are still reliable. But everything's in an opportunity cost trade-off context, right? So when I see these stocks yielding 3, 4%, even if I'm getting only mid-single-digit growth, I think that's better than walking away from income and saying I'm going to go off and try to chase more speculative forms of return. Sometimes we just have to suck it up, admit that there's not as much return to be extracted from the market. And in that context, what do? You minimize risk. You minimize risk for the same return. You don't go out and say, gee, I really need this double-digit growth or something like that. If you stretch for more than what's available, then you're going to be even worse off.
Other than staples, do you think other kind of historically higher-yielding sectors like utilities or REITs also kind of meet that criteria today? Well,
with utilities, I think you have kind of a unique situation in that I would argue fundamentally the industry is in the best shape that it's been in for 50 years. You've got lots and lots of regulated utilities that have gotten rid of their unregulated businesses, their merchant power or trading operations, or just totally wild forays into completely different industries. The industry has really cleaned itself up. There's a lot of opportunity for investment in their rate bases, mostly on the transmission and distribution side, to harden those grids, improve efficiency. As we transfer from coal into more natural gas and renewables, that's more opportunity even for T&D utilities to invest to connect these new sources of power. And the regulatory environment is generally pretty good. Regulators are supportive of these investments, even though they may mean higher customer bills. So, I mean, you can go, in a lot of cases historically, and look and see utilities can go 5-10 years, no increase in earnings at all. If they don't have rate-based growth, if the regulators are really coming down on them hard. And you can still find a few individual utilities that are not in such great shape. But for the most part, this has turned into a nice mid-single digit, in some cases upper single digit type of growth story that has 3 and 4% yields in some cases, on the right day, maybe even as much as 5. I like that a lot. I think that the new growth that you find in utilities that you haven't had in a while, insulates them from some of the interest rate pressures. On the REIT side, I think it's more of an interest rate game. I'm willing to accept interest rate risk in the case of a name like a Realty Income or Ventas or Welltower, the 2 healthcare REITs that I own, because I think they have very good growth prospects and they've locked in long-term leases with their tenants that provides you with a lot of cash flow visibility. And they've done a good job managing their balance sheets. But if you have REITs that are vulnerable to increases in interest rates, if their cost of capital goes up and they can't grow through acquisition anymore, then you may see the same kind of slowing growth that would encourage you to maybe hold out for a better yield at this point.
Josh, thanks for sharing your thoughts with me today.
And thank you too, Jeremy.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.